Hello again. This is the third and final video of the Retirement Income in 2023 presentation. In the first video, we covered Secure 2.0 and inflation. The second video, we talked about the fixed income markets. And this third video, we're going to go over the equity markets and then wrap up with some concluding thoughts about some other things we can look for in 2023 and forward. So without further ado, we're going to get into it. So obviously, stocks lost money last year. Anyone that paid attention to the market saw a lot of painful losses spread out across almost every asset class. But last year, the stock market losing money essentially isn't unique. Since 1926, the stock market has been negative 26 out of 97 years. That's roughly 1/4 the time. So, and again, stock losses happen, volatility happens, short-term volatility should be expected. It is a feature of the stock market. It's the reason the stock market has outsized returns above what you can expect from a treasury, because you do get those losing years and it freaks people out. They abandon ship and leave opportunities for others. But for those that are staying invested or that stay invested through those down years, on average in years following S&P loss, the average return is 13%. The median return for U.S. stocks, again, not an average because average are skewed by outliers that are both high and low. The median return, the middle of the road number, is about 21%. Now, obviously, there's no facts about the future. History only paints so much of a picture, but this gives us a pretty high level of confidence that historically we've seen positive returns in the periods following. Now, obviously, if we look at this chart, you can see that there's been multiple years where we've had back-to-back negative years. There's going to be a bunch of reasons where I don't think that 2023 would be one of those. But again, right now we're just painting the historical picture. This chart is looking at the context of a recession. So again, the biggest question on a lot of investors' mind, particularly in equity investors, is, are we going to have a recession in 2023? Now, if we do have a recession, it will be the most telegraphed, the most planned about and planned for, most talked about recession in really certainly most of our lifetimes, if not ever. The Fed's told us that there's a good chance there's a recession. Every commentator's told us there's going to be a recession. When polled, 70% of economists think that there's going to be a recession in 2023. That being said, the market has factored in that there will be, or there's a high likelihood of recession. And that's not uncommon. So that's why when we look at this chart, you'll see that the average performance of stocks before, during, and after recession. Before recession, stocks have actually averaged positive returns. During a recession, and this is the one that trips people up, the average return for the stock market during a recession is positive. Now, here you have some context where in the 20s, you had highly negative returns during recession, but then you have other years, 45, 48, 53, where you had wildly positive returns during a recession. And that's because they don't tell you you're in a recession the moment it starts. What happens is they come out with these figures a few months down the road, and they will tell you when the recession started and they'll tell you when it ended. But the reality is, even if you had a crystal ball and you could know exactly when the recession was going to start and you knew exactly when it was going to end and you were going to trade based on that information, I'm not sure what good it would do you, because the reality is, if you could trade and sell the day before the recession started and get back in the day before it ended, you'd probably lose money, because the reality is the stock market would have gone down before the recession started and started going back up before it ended. It's one quote I like to use to say, the stock market doesn't turn when it sees the light. It turns when things look just a little bit less black than the day before. So you're not looking for bells going off and a light at the end of the tunnel that says all clear, it's time to invest. You're looking for a time period when things look just a little bit less grim than they were the day before, and that's when markets start taking off. I'm recording this on February 2nd. We've obviously had a very good start to the year. Even since October of last year, the stock market has had a pretty tremendous run. So again, that's not to say that the stock market absolutely will be positive and that we're going to have a recession and this is what's going to happen. This is just to say that if we do have a recession, it does not give us enough, that fact alone doesn't give us enough information to trade on. Because the reality is, you could be 100% right that we have a recession, but we could also see a stock market that goes notably higher. Equity scenarios. what we're looking at here is basically just a chart from JP Morgan that shows where the S&P was at the start of 2022 and when it hit its last peak. So in January, I think it was about 4th of January 2022, the S&P was at 4,700 or 4,797. It closed 2022 at 3,840. When a stock or anything goes down in value, it has to come up more than that in order to get back to even. So for us, as long-term investors, the question isn't, will the stock market go up to tomorrow? Because I don't know the answer to that. Really, the important question that we have to ask is, how long will it take for the equity markets to revisit new all-time highs? Historically, the stock market's never gone down and not at some point revisited new all-time highs. This chart's telling us that if it took 1 year, we'd be looking at 26% returns in the S&P 500. But even if it took 5 years, if it took 5 years for the S&P 500 to revisit the all-time highs it hit in January of 2022, we'd still be looking at annualized returns of 6.4%. So again, this is a presentation, a conversation about retirement income. And I'm highlighting this here because I don't want to focus so much, because obviously bonds are more attractive now than they've been, but the stock market is still a very, very attractive place. And just because the dividend yield is only roughly 2% or even less on most stocks on the aggregate, the total return is often more important than the actual cash flow. Because if a stock goes up 20% and you want to take 5% of income, great. Sell 5% of it, distribute it, and you're still up 15%. So equities still represent a very, very tremendous buying opportunity at these levels, certainly from the beginning of the year, and even today. It's not that often that you get a 20% discount on the S&P 500 relative to what it was the year before. So we're not abandoning ship on the stock market at this point. Even though interest rates are higher, the equity markets are still looking very, very attractive. And this chart over here is just showing us the duration of bull markets and bear markets historically. And historically, bear markets haven't lasted 5 years, except for in the rare situation of 1937. But the average bear market tends to last a little bit shorter periods. So anyway, again, no facts about the future. Not saying that we're going to be in any one of these particular bars. Just highlighting this to note that even if it does take a while to get back to new all-time highs, equities are still very, very attractive at these levels. Now, this is just highlighting that dividends are really the inflation killer. So in the first video, we talked about inflation and why we thought it was coming down. But obviously, when we see inflation like we saw last year, and you're looking at a 30-year retirement, you're living on a fixed income, inflation becomes a very, very scary topic. Because obviously, if we get into another scenario where we get a couple more years of 10+% inflation, well, that fixed income you're living on no longer looks as attractive. But this is looking at since 1960, and obviously this is a long time period at this point. We're looking at something that is 60 years long, so this is probably more to make a point about the long-term implications of stocks as opposed to our retiree clients and their lifetimes. But the same concept holds true. Since 1960, the consumer price index, basically how much things cost because of inflation going up, consumer price index is up 9 times. So basically, if you bought something for $1 in 1960, it's $9 today. That being said, the cash dividend of the S&P has increased by 30 times. So if you were getting a $1 dividend back in 1960, you're getting $30 in dividends today. And of course, the S&P has climbed by 70 times itself. So when we're looking at growth over time, it's not fixed income is called fixed income because it doesn't change. If you lock in your 5% interest rates today for 30 years, it's always going to be a 5% payment. If you're getting some of your income from dividends, there's a real chance that your dividends increased over time. And historically, dividends has increased at a rate above inflation. So that is just something to keep in mind when we're looking at where do we generate income from going forward and how do we allocate our portfolio to really make sure that our income's coming from the right sources in 2023 and beyond. Closing. I told you I would tell you what's up with all these weird pictures, and the truth is that none of these pictures are painted or actually photographs. These are all computer generated pictures from DALL-E 3, I think it's DALL-E 2. You go online and I type in portrait of a basset hound 8K photograph, and this is what comes up. So in other words, the computer created this. This is not an actual dog. The same thing if we go back to some of these other pictures, that is not an actual dog, that is not an actual cat. This is found nowhere else on the internet because the computer won't recreate this necessarily. It will create new pictures every time. It's not perfect. You can see his eyes a little wonky over here. There's a couple of hairs on his tongue. But the same thing here. This is not an astronaut dog. This is not a photograph. This is just something that the computer came up with. Same thing if you go here. This is not painted by anyone. The computer came up with this. And this one, my wife just got a new white Chihuahua, so I had the computer draw this up. A white Chihuahua with a pearl earring by Johannes Vermeer. But the reality is, this dog does not exist. This painting was a work of a computer. So when we come down here, I mention all that to say that OpenAI and the rise of artificial intelligence is upon us. You'll be hearing a lot about ChatGPT and other similar AI tools. They are going to write most of the content that you see online going forward. So I say that because AI is good, but it is not perfect at this point. And especially when you're dealing with a lot of these articles, it is not going to be written by humans. It's going to be written by computers. And there are glitches. Right now, if I go into ChatGPT and I type in, how should I take my retirement distributions? It'll give me something that sounds incredibly good, but it's not necessarily right. So going forward, I imagine in 10 years' time, the technology will certainly have advanced and the information will be incredibly accurate. But for today, and certainly for 2023, 2024, you need to be looking at everything with a very, very skeptical eye. When you read something, you need to acknowledge, hey, did a computer write this? Does it sound too good to be true? Or if they're giving me facts, do these facts sound right? And they can do math and do all sorts of other stuff, but the math isn't always right. So again, anytime you see something, just look at it with a very skeptical eye. When you read something, just know that a computer may have written it and it may not be 100% accurate. It's interesting, but you need to do a little further research on topics that are important. Finally, we always had this other guy sleep. If you've seen any of our other presentations historically, you know that we finish everyone with this sleep at night factor with the man lying in his bed. Well, I had DALL-E 2 draw up a new one for us. And again, nobody drew this picture. The computer came up with this. I told him, cartoon of a happy man that fell asleep in bed under the stars. This is what the computer came up with. So again, the important part of this slide really is that your investment allocation should reflect your goals and risk tolerance. I've been talking about the equity markets and how they still look very attractive and bonds are attractive. But fundamentally, it comes down to where are you sleeping at night? Warren Buffett famously said that he'd prefer a bumpy 15% return to a smooth 12% return. But everybody has to know thyself. If you think that you're going to see the stock market go down, you're going to freak out and sell at the bottom, then you can't own those investments. If you were much happier, more comfortable with a steady return of 5+% and the fixed income markets are your preference, acknowledge that and make sure that we're not just getting ourselves in a place where we're uncomfortable. Because at the end of the day, whether it's as soon as we get every green light that says that stock market's going to go up, bonds are going to do great, something crazy is going to happen in this world. It's going to change the dynamics of what we can expect, and it's going to create uncertainty. And if we have a plan and we can stick to it, we're not so worried about those short-term swings. But if you get to a place where you're not comfortable, if you're not sleeping at night, when those moments of uncertainty happen, you're going to try to protect yourself. You're going to sell it in inopportune times, and you're going to make big mistakes. So again, the portfolio at the end of the day needs to accomplish your goals, but it also needs to make sure that you're comfortable with what you own and you're sleeping at night. That's it. That's what I got for you. And if you have any questions about this or anything else, just let us know. We'll be happy to help. And again, when you're looking at computer-generated art, this one's pretty crazy. I left it at the end because you type in a bowl of soup that looks like a monster knitted out of wool, and this is what it gives you. Or at least this is what it gave me on this one instance. So again, try it out, see what you can come up with, and look forward to talking to you soon.